Today marked the last day of trading in March of 2014, so I figured it'd be a good time to put together my portfolio update for April. And in this video, I'm going to give you the details of this month's purchase and why I chose this particular stock. And I'm also going to discuss a new strategy that I've used for the first time with the portfolio. And it's a strategy that a lot of investors use, and that's called averaging down. And we use this strategy to increase our total return and reduce risk. And I'm going to go over that in this presentation as well. So if you're not familiar with the portfolio, this is a small stock portfolio. It's publicly viewable. I publish the results and everything I do. Every move is made. I only try to do one move a month, and it's either at the very beginning of the month or towards the end of the previous month. So for this update was April's update. I actually purchased my stock right at the end of March. So I try to keep the trades right in that area. I limit trading. I try to make one buy, and if I sell, I publish that I sell. So far, I've just bought though. And the purpose of this is to invest anywhere from $500 to $1,000 a month into the portfolio. And the purpose is to show home-based investors not only how to pick stocks, but how to invest over time, how to steadily add to positions to increase your return. And I provide monthly, quarterly, and annual updates. This does have risk, but the total sums are small, so I try to keep it manageable even for the working class here. So with this month's purchase, I picked up LinkedIn, and I purchased 5 shares at $187 a share. And this was actually the same purchase I made at the very beginning of the portfolio. It's my very first purchase when I bought LinkedIn at $200.66 a share. So I now own 10 total shares with an average purchase price of $193.83. And why did I pick LinkedIn? And if you follow this portfolio last month, I stated that I'd set a price target to add more shares of LinkedIn at $187.50. And what this means is that if LinkedIn dropped under 187.5, I was going to buy more shares. It did, so I went ahead and bought more shares for this month's purchase. And this isn't a huge drop. You might be wondering how exactly I came up with that number. And the reason is I thought the original $200 was a really good price for LinkedIn, based on how the company was doing and how it's traded historically. And I just didn't feel like LinkedIn had a lot of room to drop, given that it was already attractively priced at $200. So the price target was minimally lower, about 6 or 7% lower than the original purchase price. And the purpose of buying these extra shares is that buying additional shares of a stock that has fallen in value after you make your initial purchase is a process known as averaging down. And because I bought more shares of LinkedIn at $187, my original investment, which of $200, those two combined to an average purchase price of $193.83. Now, if LinkedIn merely just returns to the original price I invested in it at, I will be up 3.5%. And if LinkedIn drops more, I'll look to add even more shares to get my average purchase price down. Eventually I think LinkedIn's going to turn itself around. The company's doing great, but sometimes the stock price doesn't always trade with the company, just because when a company is growing very quickly, its price is often many times higher than what it's really worth. As long as the company continues to grow, though, it should be able to shake off these short-term fluctuations in price. And to make sure you get the right price to get a good return, you need to average down when it drops. And I was particularly eager to add on to more shares of LinkedIn because I believe they have an immediate near-term upside. And the reason I say that is I think as soon as next quarter we could see a nice hike in LinkedIn's price. They issued a very conservative guidance. I think it'll be very easy for them to beat it. And if they do, I think we'll see, a price hike on LinkedIn. And just to give you a quick update on some of my previous holdings, I did buy Zillow at the beginning of March. That was March's purchase. Actually, it was at the very end of February. And it was up to $100 briefly a share, but it settled down at a few percentage points up from where I bought in late February. So that was good. The problem stock right now for the portfolio is Potbelly and PBPB. It was down pretty big this month. And I wasn't particularly eager to add shares just yet, just because the stock does not have immediate upside like LinkedIn. And there's too many short sellers, and there's no positive catalyst on the horizon. With LinkedIn, I think they're going to have a great earnings report. Potbelly, I'm not so sure. I like Potbelly a couple years from now. That's why I own their stock. I'm worried that the bad weather that we've been experiencing in the first quarter of 2014 is going to hurt their next report. And the reason Potbelly is particularly susceptible to this is because over half of their stores are concentrated in the areas in the Midwest, the North Midwest, and the Northeast, the two areas that were really affected by the bad weather we've been having. So they're much more likely to be hurt by bad weather than a retail store or another restaurant that's spread out all over the country. And really, March, all in all, was just a really bad month for growth stocks, and that just happens when you invest in small and mid-cap stocks. I'm not too worried about the outcome over the next few years, but I'm more interested in I'm more worried about the outcome over the next few years than I am worried about the month-to-month outcome. I don't care if this portfolio is down 2 or 3% in a month. I want it to be up 100% over 4 years. That's the kind of goal we're going for. We're not going for the month to month because you have the ups and downs. That just happens, especially investing in the types of stocks that I do. I just want to get back to this really quickly. I wanted to average down on LinkedIn because I thought that they had a good chance to move up, and that's exactly why I didn't average down on Potbelly. Just rehash. I don't think that Potbelly is going to be able to easily shake off its momentum. And I also want to discuss one more thing about actually averaging down. I don't have a slide for this, but the reason averaging down doesn't get a lot of, play, and it's really downplayed by a lot of mainstream investors, is that it's not a foolproof plan. If you buy a stock for $20 a share, it drops to 15, and you buy stock at $15 a share, what happens when it drops to $10 a share? Do you buy at 10 and push your average purchase price down? And the answer really is that it depends. You can't buy more shares of a stock that's going down in price because the business is declining. That's the key thing to remember, because when I'm averaging down on LinkedIn, I'm doing it because I assume that LinkedIn is going to be capable of continuing its rapid growth. LinkedIn pulled back in price not because the business is bad, it just happened to trade down. Growth stocks let off some steam. Twitter and Facebook fell big. I think they kind of pulled down LinkedIn with them. But when LinkedIn continues to grow, its share price is going to move up as well. And that's why I average down on LinkedIn. Sometimes when a stock falls in price, it's because the business sucks. The business is bad. Like, for example, JCPenney. If you would have, quote, averaged down over the last 10 years as that stock's plummeted to the bottoms, as they're teetering on bankruptcy, that doesn't work because the company has no way out from that. It has no way to increase the value. So when you average down, you have to make sure that you're investing in a company with a very bright future. It's good to average down on a growth stock that might cool off a bit after you enter, or as Warren Buffett would do, to invest in a stock that's still a great company, but it's just down on its luck. It just needs a little polishing. Kind of like when he bought Bank of America. They fell so much because they had so much toxic debt with the mortgage crisis, but their actual business was still intact. They had a way out. Eventually they'd sort through all those foreclosed homes and their fines and whatever, but they actually had a real business model underneath. And now that they're starting to climb their way out of that mess, he's made a huge amount of money on that investment. So that's what you have to do when you average down. You have to you can only buy a stock on its way down when it actually has a chance to go somewhere. And the other problem with averaging down is sometimes it can take a while for the stock to go somewhere. And the reason is a stock might be a great company, but just has negative momentum. A stock might represent a company like LinkedIn, which has been steadily declining in price since about July of 2013. It takes a while. Once a stock, runs up 100% in a couple months, it can easily lose, 30%, lose some of its gain, and take a while for it to finally turn itself around, even if the company is doing spectacular the whole way. So that just happens. You've got to be prepared to wait out the downward momentum and to continue to average down on the way down. And again, this only works if the company's solid. So hope that cleared some things up for you. And go ahead and subscribe to my channel. I'm going to be posting 2 videos this month at least. One will be the best stocks of April to buy, based on what's fallen in price. Obviously, I think LinkedIn's a good one at its current price. I just bought some. and another video on the actually quarterly update for this same portfolio. I'm going to do a video where I discuss the year-to-date return, which is, it's a little negative right now, but growth stocks haven't done well so far in 2014, so that's just kind of to be expected. And I'm just going to discuss what I hope is, what I project is going to happen over the next year, and what my plan is for purchases over the next year, what the direction I'm taking the portfolio is going to be like. So go ahead and subscribe to my channel for more updates, and I hope you follow along.